Good morning, Jags. This is Fahad. Today is Friday, March 5th. Let's get started. A lesson from history here. Let's see if we can find some relevance to what's happening in the market right now by looking at the history. The chart that you're looking at in front of you is long-term, 15-year chart of the 10-year bond yield. And so you can see that this has been the trend, ups and downs, lots of zigzags, but generally coming down and down and down. Let's focus on this area right here, which is the period from 2010 to 2013. Now you will notice over here that in 2010 and 11 and 12, bond yields came down sharply. The 10-year bond yield was as high as 3.5% back then, and then they hit a low point of only 1.5% before rebounding sharply. Let's zoom into this particular picture. So let's go to this chart. This is the 10-year bond yield. This is 2011, this is 2012, and then check out what happened in 2013. You can see right here that the bond yield came down from 3.8% all the way to a low point of 1.3% and then stabilized over there. And then all of a sudden, out of nowhere, starting from April or May of that particular year, 2013, we had a sharp rise in the 10-year bond yield, doubling essentially in the matter from May to September. So in just 4 to 5 months. A huge incline. I remember fully that day, that particular time period, because I was trading the markets very actively when I used to be with Option Monster. And this became a huge headache for the market when this happened, because it's the velocity or the speed of change that happened. This was in the middle part of 2013. How did the S&P react at that particular time? Here is how the S&P reacted that year in 2013. You can see that beginning from 2013, during January, February, March, April, and May, we were rising rather steadily with only modest pullbacks, 1 to 2% pullbacks along the way. But then as soon as a sharp rise in bond yield started to show its face, starting from May, we went into a corrective period for a total correction of 7% at that time, creating some jitters on the market. But then we stabilized. After some panic, some buying came in, we stabilized, and then we went on. Within 3 months after the first jitters appeared, 2 to 3 months later, we were making new 52-week high in the S&P. Bond yields were still rising and the concerns were still happening the whole time. And so we had a bit more volatility in August, September, October, but it did not derail the rally. We continued to go higher. There's always some chop fast, but we generally continue to trend higher, and we finished the year extremely strong on the high note. Also, if you look at on NASDAQ for the same exact period, why is NASDAQ important? Because anytime when bond yields are rising, the concerns about inflation appear. Whenever there is reflation trade in play and concerns about inflation are appearing all in front of us, it tends to destroy the momentum in NASDAQ first and the most than anything else. And so naturally that period too, from May to July or late June, NASDAQ had an overall total correction of 9%, giving back at that time pretty much all of the year-to-date gains, precisely how it is happening right now. At one point that year, NASDAQ was nicely higher by double-digit percentage, but at the very low point in June, NASDAQ was almost flat on the year. Did it stop the rally? It did not stop the rally. The panic ended, and we continued to move higher. Within 2 months later, we were making new 52-week high, and the march is still continued despite some short-term jitters. But guess what happened to the bond yield that year? Bond yield still did not stop. Towards the end of the year, bond yields were still going higher, and they continued to go higher that year in 2013, finishing the year at the highs of the year. Did it stop the market, S&P? No, it did not. Did it stop the market, NASDAQ? No, it did not. Why did it not stop the market when it was creating so much chaos? You see, talking heads and pundits on TV, they will come out and they will tell you that bond yields, rising bond yields, is going to just destroy every single thing. But Most important thing is you have to focus as to why the bond yields are rising to begin with. Good reasons or bad reasons. A good reason would be that we are reopening. As we reopen and we start to rehire, naturally you would see upward pressure on everything. You would see upward pressure on hiring. You would see upward pressure on wages. Wages is a big component of the CPI and the PPI calculation. You would see upward pressure on commodities. Commodities are reacting to improving economic outlook. That's a good reason. On the other hand, if inflation was sparking purely because of too much excess of money supply without the underlying economic demand, economic environment improving underneath, that would be the bad type of inflation. So what's happening around us? Here are the COVID-19 cases in a hard Republican state, Florida, coming down hard, starting from early January. We are at the lowest point in at least a couple months, and the trends for daily cases, hospitalization, positivity rate coming down. Here are the number of cases in New York, a hard Democratic state, coming down hard. In all three cases, hospitalization, positivity rate, everything is coming down. Why is all this happening? Because we are vaccinating a lot of people. Here's the US chart. We have already vaccinated 27% of the population in the United States already. 27% of the population. We are vaccinating 2 million Americans per day, 60 million Americans per month. Why is that a bad thing? It's not a bad thing. Should you really be worried about rising bond yields and your stocks coming down? No, you should not be. Why? Because of news like this. Take a look at this. This is the small businesses job survey that was done by a nonprofit organization. Small businesses, the very businesses that were hurt the most by COVID, they're adding jobs. 32,000 jobs were added in February. Or you can take a look at this article from New York Times that came out on March 3rd. This was just 2 days ago. What about what? A wave of reopening. That is the title of this article, A Wave of Reopening. Or if you don't believe me, just moments ago, as I'm making this podcast, the non-farm payroll data that just came out. Guess what? 379,000 jobs were created in the month of February. Now, what was I telling you in the chat room yesterday, as well as in webinar the day before that? And all that I was telling you, I have been a bunch of client questions were asked, and I mentioned this many times that we are going to see a very strong job growth. Here is the summary of that job report that just came out. Take a look at it for yourself. Right here, 379,000 jobs created in the month of February. The consensus was 175,000. That's more than double the consensus. Prior month was revised higher from only 49,000 gains to 166,000 gain. And the month before that also, which is not in this list, was also revised high. Why is that bad? It's not bad at all. Private payroll, which bunch of it tends to be small businesses that are coming back. Take a look at these games. 465,000 jobs created in the month of February versus 183,000 consensus. Manufacturing added jobs. Participation rate is steady. The average hourly earnings were up 5.3%. Every single thing is absolutely fabulous in this report. So let me ask you this. You see this earnings report that just came out. Are you going to come to this market today? Let's take a look at S&P futures chart right over here. And now let's go to single day or daily chart. These are the daily candles. You're going to look at this report at 379,000 jobs, and you're going to say, oh my God, I got to sell everything out of my portfolio. Why? Because bond yields once again are reacting positively this morning. The Treasury bond yield this morning, after this job report came out, take a look at the intraday, have now once again spiked from 1.54% to 1.61%. I got to sell everything. I'm out of here. I'm done. Or you're going to look at this and you're going to say, economy is improving. Things are getting better. We're creating more jobs. The business, naturally, there's going to be an upward pressure on inflation across the board. It should be good for stocks. It should be good for manufacturing. It should be good for a lot of businesses. If I'll tell you this, if the bond yields were actually coming down, then I would be really, really worried. That would be the scenario that would be unacceptable to me, and then I would go bearish on the market. This is a reaction. What's happening in the bond yields is a reaction to strong economic data. And you should praise that and be comfortable owning really good companies, particularly cyclical stocks, the value stocks that we have been discussing all this time. This is not bad. This is very, very good. This correction will be over, and I will not be surprised if within a couple months the S&P is making new 52-week highs rather very quickly. That's it from me. Let's go to Jay.
Morning, everyone. So today, I just want to highlight Stryker, SYK. So there is a potential catalyst, potential product that you're going to want to keep an eye on, but it's definitely longer term in nature at this point. So the company in late 2020 completed its acquisition of Wright Medical Group. If you then fast forward to the earnings call, which happened in late January, in the Q&A session, UBS, that analyst would ask management, could you give us updated thoughts on the timing on a robotic solution for shoulders and for spine? Now, with regards to shoulders, the CEO of Stryker, Kevin Lobo, would respond, we're not really ready to give a timeline yet. We have to get a lot closer to launch before we're going to be specific about timelines. I would say that I'm extremely bullish about shoulder. I think I've said that in the past. It's a very difficult procedure to do. There are enabling technologies within Wright that our teams are working on with our Mako teams. And so we're very excited to be able to bring that to the market with their market-leading implants. This morning, Credit Suisse is out with a note titled, Expecting Rapid Adoption of Robotic Shoulder, which could be Mako's second killer app, potentially starting within 12 to 18 months. So they hosted a conference call with individual Dr. David Lin, who is a orthopedic surgeon and chief medical officer and chairman of orthopedic surgery at Reed Health Outpatient Care Center in Richmond, Indiana. And Dr. Lin regularly uses the Mako product or the Mako system for knees and hips. Dr. Lin believes that we could potentially see a Mako shoulder application from Stryker within the next 12 to 18 months in line with Credit Suisse's expectations. However, Dr. Lin's expectations of performing at least 50% of his own shoulder surgeries on the robot by the end of the first year after the application is launched is ahead of Credit Suisse's previously published expectations of less than 5% in the first 2 years. Additionally, since most shoulders also get CT scans given how hard the joint is to access, they also naturally lend themselves to pre-op planning software and robotics. In terms of pre-op planning, Dr. Lin views Wright Medical's Blueprint 3D planning software as differentiated and complementary to Stryker's Mako system, facilitating better surgical planning and execution. So this is the next product you're going to want to keep an eye on from Stryker.
Excellent update. You know, Stryker has been one of my favorite med stocks. Very, very well established company, strong foundation. It's just a beautiful play all the time. When you want to bet on improving trends in the hospitals and surgeries, generally speaking, because it makes all the equipment, right? All kinds of surgical equipment. So it's not tied to one particular category of surgery, but everything rather. So it's a broad play on that. And with reopening once again, this should be gradually trending higher, and this update enhances that view particularly. So I expect as we continue to go on from here, we're going to keep seeing a steady improvement in the business conditions, and the pullbacks in the stock will remain shallow and will remain buying opportunities. So good update on that one. Let's go to Chronicle.
Morning. I have two things today. First off, just very quickly, I'm upgrading my near-term outlook on Take-Two Interactive from bearish to neutral. So back on February 2nd, we did a video where we said we were near-term bearish but long-term bullish. But in that video, we laid out all the reasons why the stock was trading too high in the near term, and we also said that our bearish target would have been around 170. So given the recent sell-off, I think the stock is now more appropriately pricing in all of the headwinds that we talked about. and it's made for a nice short if anybody caught it. So now that it's hit our target, I'm going to move to the sidelines and wait for further clarity on the company's pipeline for the second half of this calendar year. So for Take-Two, I'm upgrading short-term outlook to neutral and keeping long-term outlook as bullish.
You know, Chronicle, I have to praise you here, buddy, because you absolutely so far has perfectly nailed it. I had, as you know, before we presented that video on Jaguar Media, about Take-Two Interactive, I had a little bit of my concerns and doubts that because the chart, the strength in the technical picture was so strong, but we presented a case that short term we are bearish, long term we are bullish, and we would expect a pullback to 70 that will give us a buying opportunity for the next leg higher in going into second half of 2021. And that's exactly what happened. Doesn't matter how strong the chart was technically, the case worked out beautifully. Went straight down. Naturally, the market meltdown also helped, but it hit your perfect target of 170 as well, which is a major VOP support. So, so quickly, just to wrap up on this one, you're expecting some basing formation here, technically some stabilization, maybe like here we saw back in October, November last year for a month or two, and then a gradual recovery from there.
Yep, I'm expecting some announcements as we get into the second half of the year. So yeah, a basing formation would be a realistic scenario.
Awesome. All right, good.
So my second item today is a bullish case on Lincoln Educational Services, symbol LINC. I don't have a position yet, but it's on my watch list, and I like the relative strength that I've been seeing in the stock over the past week. To give a bit of background, this company provides career-based training and technical education for basically everything from automotive, like training to become a mechanic, to all sorts of manufacturing, plumbing, culinary arts, as well as IT. And their certificates are among the most well-recognized across the country. Now, the main reason why this is on my watch list is because I think after this final round of stimulus checks gets passed, a lot of unemployed young adults are going to start looking for ways to improve their resumes to make themselves more employable, especially after having had a taste of what life can be like at the equivalent income level of all those unemployment and stimulus checks. Because judging from the opposition that this upcoming round of stimulus is facing, particularly from the centrist Democrats, I really think this is going to be the last round. And so this could result in a tailwind for technical education providers like this company. Their certificates don't take very long to complete either, about 6 to 8 months. Some are 12 months. Like recently, I've been talking a lot about shipping and offices, and I think this could be another sort of hidden reopening play, especially given that initial jobless claims and unemployment are still elevated. Okay, so that's my main top-down thesis. Now, from a bottom-up perspective, on Wednesday, the company reported a nice beat on both EPS and revenue for Q4, 31 cents and $82 million respectively. And not only did they see student population go up by just under 10% year over year, they also saw a 15% increase in new student starts, which helped their cash from operations more than double to 13.3 million. And that's now 3 consecutive quarters of 15% growth in student starts, while the show rates have remained strong. This is their strongest period of growth in more than 10 years, by the way. Now, Canaccord, in their post-earnings note, would also add that perhaps the most surprising beat in this earnings report came from the EBITDA and EBITDA margins of $12 million and 15% respectively. Impressively, their healthcare segment posted 20% margins, and their transportation and skills schools posted 30%. So their analyst, Austin Muldo, notes that the main driver was operating leverage across marketing, admissions, and student services. These are permanent improvements. And additionally, their online learning programs are also helping to contribute to the better margins. Separately, I would add that in the conference call, management would say that they are expecting adult leads for this year to come in higher than the initial guidance they've given, and that they are also beginning to incorporate training programs in solar energy and solar panels. So maybe they could also be a hidden beneficiary of anticipated infrastructure stimulus. Who knows? So all of this is essentially why it's on my bullish watch list. And talking about valuations, this company is making just under $300 million in sales per year, and the market cap is 150 million. So this is not even trading at one-time sales. And when we factor in how the EBITDA margins have been improving, as well as, due to the permanent improvements to operating leverage, I think there is potential here for a significant re-rating. I think the street high price target right now for the stock is $12, if I'm not mistaken.
Very interesting, and I think that you're definitely on the right path over here. That as the businesses continue to reopen and we rehire in this economy, there should be continued surge and importance of providing new skills to the ever-changing climate for businesses from with the academic programs that are specifically designed for transportation and other skill programs, for automotive, diesel, heating, ventilation, HVAC, welding, manufacturing, and all those kind of things. And this company provides all of those programs. Rehiring should lead to surge in and strength in overall in skill training programs. And as a result, this company should remain. Why is it so cheap? That's a very interesting question. Trading at only half time, it's only 0.5 times sales, and I'm looking at some of the other ratios as well. This company has a book value of $2.16 per share. Stock is trading just under $6. It's trading at only 2.5 times, not a book value. It has $1 per share in cash, so about 15% of the market value is in just cash position. Interesting. Why is it so cheap? Maybe just a forgotten name. On an EBITDA basis, if you look at this thing is trading at less than 5 times EBITDA in cash flows. Seems very, very cheap here given the underlying dynamics we have in place. So one definitely to watch. I'll add this to my watch list, and I'm going to wait until this stock clearly starts to break out from this base before taking a position. I think you may be right about potential for re-rating here substantially. So we'll be watching this carefully. All right, good stuff, guys. Thank you very much for joining. That's it from us. We'll see you in the chat room shortly.